Last Monday was something to remember. The Japanese stock market had its worst trading day since the 80s, dropping by 13%, then Bitcoin dropped by nearly 20% in a single day, and now the fears are spreading to the American and the European stock markets, with tech stocks being hit especially hard. In fact, tech stocks are actually now already in a correction, having dropped by 12% on average, and this has led a lot of you to ask me what's causing this crash, and even more so, what am I buying following this correction? Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to explain to you what's causing this recent volatility and how I'm taking advantage of it, what specifically I'm buying at the moment. But before I get to it, I wanted to remind you that I just recently launched a new free newsletter on Substack. There's a lot of free research there on some of my top picks for the second half of the year, so if that could interest you, I'll put a link to it in the description of this video. So firstly, what's causing this recent volatility? And I think that there are really three key reasons. The first one is that there are growing fears of a recession. The consumer is now weakening. Real-time inflation has dropped below 2%. According to Trueflation, which is a private measure of real-time inflation, it's actually at around 1.5%, which is the lowest in a very long time. And so because of this, the Fed is now signaling that it's going to start cutting interest rates. All of these things are signs of a weakening economy, and it reminds me of this meme that I recently saw on Twitter where there is a doc that's asking someone, why do you think that rates are falling? And what this meme is trying to say is that perhaps we shouldn't be celebrating rate cuts because they're actually the result of a weakening economy. Then the second reason why stocks have been dropping lately is this whole Japanese carry trade thing. And if you're not familiar with that, essentially what happened over the past few years is that interest rates were consistently a lot lower in Japan than in the US, and as a result a lot of investors went to Japan to borrow yen, and they would then reinvest it in US dollar in the US, in treasuries, in stocks, in real estate and other assets, hoping to earn a positive spread. And over the past years it worked really well because the spreads were historically large, and then on top of that the American dollar was also appreciating relative to the Japanese yen because the Fed was regularly pushing interest rate hikes, whereas the Japanese interest rates were remaining stable. But now it's the opposite. The Fed has clearly signaled that they will start cutting interest rates already in September, and to make matters even worse, the Japanese central bank decided to just recently hike their interest rate, and what it's causing is that the Japanese yen is now surging in value relative to the US dollar. As a result, a lot of these carry trade investors are now suffering large losses on their position, and it's forcing them to sell their US assets to pay off Japanese borrowings, and so it's leading to a lot of selling pressure. Hey, could you please do me a huge favor and click the like button? That helps me a lot to keep growing. Thank you so much in advance. And then the third reason why stocks have been dropping lately is the whole situation in the Middle East. It's been widely expected that Iran will launch a big missile and drone attack on Israel really at any moment now, and understandably the market is concerned as the world is getting closer and closer to a third world war. And so with all of that in mind, many of you may think that now is a good time to hold some cash, some short-term treasuries, which are still offering a pretty good yield, especially given that valuations are still relatively high and there is significant uncertainty. But I'm not doing that because I don't think it's possible to time the market. I have a very long time horizon. I don't really mind volatility. I have a pretty high risk tolerance. And most importantly, I'm still able to find some great pockets of value in key subsegments of the market that remain hated by most investors. And the first one here are real estate investment trusts, and I may sound like a broken clock to some of you because I've been pitching REITs for such a long time, but the reality is that they are priced at near their lowest valuations in over a decade, and I think that eventually valuations will matter. And this seems to be finally the case. REITs actually surged by about 10% over the past months, even as tech stocks dropped by 10%, so leading to significant outperformance, and I think that this is likely to continue. Following the dot-com crash, tech stocks went through a long period of near 0% total returns, and during the same time periods, REITs were highly rewarding, generating strong double-digit annual total returns, and could we see a repeat of that? I really wouldn't be surprised, and in fact, I'm betting on it. Right now, you can still buy high-quality REITs that have Class A assets, strong balance sheets, investment-grade ratings, amazing track records, steadily growing rents at just about 50% of what they were trading at a couple years ago, and since then their cash flows and dividends have actually kept on growing, so they are often even cheaper than that. Good examples that will come to my mind right now include SAB Communications, ticker symbol SBAC. This is one of our favorite cell tower REITs at the moment. We've recently initiated a position in it for a core portfolio at High Yield Landlord. And by the way, if you want to access this full portfolio, I'll put a link to a 2-week free trial in the description of this video. But that's one of those cell tower REITs that we think is very heavily discounted, and we expect significant upside now in the coming years as interest rates are cut. Its business is not cyclical whatsoever, so recession doesn't really matter. It doesn't have that much leverage. The REIT is actually buying back shares at the moment to take advantage of this low valuation. Another REIT that could be a good example here is Rexford Industrial Realty, ticker symbol REXR. This is one of our favorite industrial REITs at High Yield Landlord. We hold it in our retirement portfolio. It owns mostly properties in supply-constrained markets of Southern California, and what's interesting here is that its lease rates are deeply below market because most of its properties were under long-term leases, and market rents grew a lot faster than its lease escalations, and so as a result now its lease rates are about 30-40% below market levels, and so as its leases gradually expire, it's able to bump up very significantly its rents, and that's not really reflected in its market valuation at the moment in our opinion, and so we think that this is a great opportunity. But I'm not just buying REITs, I'm also taking more risk by buying some more cyclical companies that have sold off very heavily over the past weeks, and good examples of this would be nightclubs or casino operators or alternative asset management companies. Patria is a company that I pitched recently on this channel. It has dropped quite a bit in the past few weeks, along with the other asset managers as well. KKR dropped by 10% on Monday alone, I believe. Patria has also been dropping despite actually reporting very strong second quarter results. It hiked its guidance for 2024, also for 2025. It also initiated a buyback. Everything is going according to plan, and yet it's been dipping, so I'm buying the dip there. But there are some other similar companies that I think are quite interesting, and a great example of that is Caesars Entertainment, ticker symbol CZR. This is the leading casino REIT in the US. It operates many iconic assets like the Caesars Palace in Las Vegas, and its share price is now down about 70%. This would seem to indicate that the company is doing really poorly, but it's not really the case. It's mostly just recession fears and also the impact of the rate hikes, but it's really the recession fears, and the market is correct that Caesars is one of those companies that will likely suffer if we go into a recession because it generates a very significant portion of its profits from the Las Vegas strips, which is reliant on discretionary spending, which would go down in a recession, but we just think that this is more than priced in at these levels. The company is strongly free cash flow positive. It has its leverage under control. I think that it could handle it even if we go into a deep recession, and I think that what a lot of investors here are overlooking is that the company owns a lot of very valuable casino real estate. It has sold some of them to REITs like Vichy Properties and Gaming Leisures Properties, but it still also owns a lot of real estate, including properties like Paris in Las Vegas, The Link, Flamingo, Planet Hollywood, many other assets, and I think that it could tap into this real estate portfolio by selling them and buying back shares instead to create value for shareholders. It also has a rapidly growing digital gaming business, which I think is now at an inflection point. If you want to learn more about this opportunity, we just recently discussed it at High Yield Landlord. Again, there's a link for a free trial in the description. But these are the type of companies that I'm buying at the moment, because I think that if you look now a few years out, you remove the recession fears, interest rates have come down to low levels. A company like Caesars could very easily trade at double its current valuation or even triple, especially if its digital gaming business has kept on growing, because currently the market is not giving any value to it, even as some of its peers like DraftKings are trading at very large multiples. So there's very significant potential in a company like Caesars over the coming years. The way to the upside will likely be volatile, but again, I have a high risk tolerance, and there are many such opportunities in today's market. So I'm allocating about 50% into REITs and a lot also in this type of companies, because I think that they present significant upside, especially after their recent dip. So that's what I'm doing to take advantage of this correction. Once again, if you want to access my entire real money REIT portfolio, there's a 2-week free trial in the description. It will give you immediate access to my entire portfolio. If you cancel within the first 14 days, you won't be charged anything. It will also give you access to all my top picks for the second half of the year, a course on REIT investing, and many more things. A chat with other investors that are part of our community. You will have direct access to myself. Finally, if you could please click the like button, that will help me a lot to keep growing this channel. Subscribe as well. I have a lot of interesting content planned for the coming weeks. Thanks so much for your support, and see you at my next one. Bye bye.